OEICs, unit trusts, investment trusts, ETFs. There are tons of different kinds of funds you can invest in. But do the differences between them really matter? Well, yeah, they do. So let's get into what those differences are and why you need to know about them. Hi and welcome back to the channel. My name is Pete. It's very nice to meet you. Investing is, at its most simple, exchanging your cash, which is inert, only ever produces a little bit of interest, exchanging that cash for assets that can produce a meaningful income, an increase in the value, or both of those things. For investors, those assets are mostly shares, sometimes called equities, bonds, property, and commodities. There are others, but those are the main ones. Now, you could buy shares in a handful of companies, but that soon becomes hard work to manage, and the paperwork can be pretty intense. Also, by only owning a few different shares, your risk is pretty concentrated. Investment funds are the solution to this because a fund pools your money with that of all the other investors in the fund, and that equals a pretty large sum. With that large sum comes economies of scale and also the buying power to buy lots of more shares in lots of different companies all around the world. And most investors should use funds for these reasons, at least for the bulk of their portfolio. So I'm going to look at the main types of funds and their pros and cons. Remember that as always, there are chapter markers, so you can jump to the parts of the video that are most useful for you. We need to understand the difference between closed-ended and open-ended funds, and it's pretty simple really. Any fund is divided into shares or units. So let's use a simple example of a fund divided into just 10 shares, and let's say they're worth £1,000 each. Well, if this was an open-ended fund, if somebody new wanted to invest £100 into the fund would simply create another share. If someone wanted to invest £2,000, they would create 2 new shares. If somebody wanted to take out £1,000, they would simply cancel that share and pay out the cash. And so the extent of the fund, the boundary, if you like, is open-ended. It can flex up or down depending on the inflows and outflows of the fund. Now, the value of each share in the fund is only based on the value of the underlying holdings owned by the fund. The value isn't directly impacted by people wanting to buy in or sell out of the fund because of this flexible, open-ended nature. But a closed-ended fund is different. Here, there are a fixed number of shares in issue. So taking our example, there would only ever be 10 shares in existence. No new shares can be created or destroyed. And that means if you wanted to buy a share in the fund, you would have to find someone who was willing to sell their share. And that means that shares in closed-ended funds are affected not only by the underlying assets that the fund holds, but also this sentiment of investors. If loads of people want to sell, and not many want to buy, the share price will fall, maybe even to below the value of the underlying assets. That's called trading at a discount. If the reverse is true, and lots of people want to buy, then the price will rise, and may even rise higher than the value of the underlying assets, and that's called trading at a premium. Both open-ended and closed-ended funds have merit. They're definitely worth considering. By the way, if this is useful, do me a favor, hit the like button, subscribe to the channel if you haven't already. Thank you, you're very kind. With the distinction between open-ended and closed-ended funds in mind then, let's power quickly through the main types of funds that you're going to come across, starting with OEICs, which stands for Open-Ended Investment Company. And there are some clues in the name there. It's open-ended for a start, it's about investment, and it's a company. OEICs usually have a single price structure. So the price that you buy the shares at is the same as you sell them at. Other funds are often different. I'll come to that in a minute. OEICs are by far the most common type of fund. Chances are if you're invested in a fund already, it's an OEIC structured fund. You get all the benefits of collective investment. Diversification, regulation, accessibility, economies of scale. An OEIC fund should always be pretty liquid, and that means you should always be able to get your money out, though that also does depend on what assets the fund holds under the bonnet. The main negative of OEICs, and really this applies to all funds, is costs. It always costs money to get the benefits that we've been talking about. OEIC funds are priced daily, so the share price is set just once a day, and it depends on the combined value of all the underlying assets at a particular point in the day. Sometimes that's midday, sometimes it's close of trading. But it's the combined value of all the assets held by the fund divided by the number of shares in existence. That's how you get your share price. Let's talk about unit trusts next. And again, the clue is in the name. Firstly, unit trusts are set up under trust law, not company law. The fund managers are essentially trustees, and they are charged with acting in the interest of the unit holders, not shareholders, because there are no shares. The fund is divided into units. Other than that, from an investor's point of view, there aren't really any practical differences between OEICs and unit trusts, except one. Unit trusts are also priced daily, just like OEICs, but there is a twist. Usually with unit trusts, there are two prices. The offer price, which is what you buy the units for, and the bid price, which is what you sell them for. And the bid price is always lower than the offer price. So if you were to buy your units one day and sell them the next, you'd automatically make a loss because of the difference in the two prices. You can think of it as an initial charge for investing. And personally, I would never recommend that somebody buy a unit trust these days for that reason alone. I just don't see why you should pay an initial charge for something when there are other options where that's not the case. Okay, next up, we've got investment trusts, and these are an underused but a really important option for investors. Annoyingly, the clue is not in the name, because they're not trusts at all, but companies. They are closed-ended, so remember what we said about that. And remember what we said about the share price being driven by both the values of the underlying assets, but also investor sentiment about the fund itself, its management and its outlook. One big benefit of investment trusts is that they can borrow money to leverage their investments, something that isn't open to other types of funds. And this by definition increases the risk of the fund, but managing that risk is essentially what you're paying the fund managers to do. Because investment trusts are actually companies, their share price changes throughout the day rather than being set once a day. And that means you can trade them like you could any other share, setting stop losses or whatever. You will sometimes pay higher fees for investment trusts, but not always. Often they're really long established, over a century some of these investment trusts. They've got pretty slick operations and significant scale, so they can keep their costs down. The biggest risk, I guess, is that they could become illiquid. That means if you want your money out and there aren't buyers for your shares, you might have a problem. In practice, though, that's unlikely in any normal functioning market. And the final main type of fund that you'll come across is an ETF, or an exchange traded fund. These are special kinds of funds that usually, though not always, track markets or indices, or maybe they track the price of a commodity like gold. They are open-ended, but unlike most open-ended funds, they trade throughout the day. So the share price is continually moving, so it's a bit more like an investment trust in that regard. They are very low cost as a rule, which is good, but to buy and sell them, you might have to pay dealing fees because the shares are traded continually. More and more ETFs are being introduced, and they're really being embraced by investors who are increasingly convinced by the low-cost benefits of them. Got to be careful because ETFs will track their markets in one of two ways. They will either physically track them by actually owning the underlying assets that they are trying to track, or they will synthetically track them by buying things like derivatives and options to try and simulate tracking the commodity price. Generally, I suggest people stay away from synthetic ETFs and stick with physical ETFs, just because you kind of know what you're getting. Let me very briefly mention two kinds of funds that are unique to property investing. The first is the REIT, or Real Estate Investment Trust, and these are investment trusts which are set up to allow a group of investors the opportunity to invest in property. They are required to distribute at least 90% of their profits to investors. They don't pay corporation tax on their property management activities. And we also have PAIFs, or Property Authorized Investment Trusts, which are basically the open-ended equivalent of a REIT, and they share very similar characteristics. I'm not going to go into too much depth on those because you'll come across them, but really we've covered the main types. We have, though, barely scratched the surface here. We've covered the main structures of funds, looking at open-ended and closed-ended funds, And then obviously we talked about OEICs and unit trusts and investment trusts and ETFs, some property equivalents. But we haven't talked about income or accumulation shares. We haven't talked about active versus passive funds, and there's probably quite a bit more that we haven't talked about. So let me know in the comments if there's anything more that you want on this subject. I can always do a part 2. Now, I made a video called Investing Made Simple, which gives you what I believe is the best approach for most people. I'll put that video up here. Might be a good one to watch next. But I hope today's video was helpful. If so, please hit the like button and subscribe to the channel if you're not already. It really helps, so thank you in advance for that. And thank you so much for watching. I'll see you next time.